Hello, everyone. Thank you all for joining us today. Hopefully you can all hear me okay. So we'd like to welcome everyone to this special webinar that Blue Chip are holding. This is in relation to auto-enrolment, and our aspiration today is to provide some practical insights and supports for businesses, for business owners, and to hopefully provide some clarity on that. We're joined today by our pension expert. Our guest today is Neville Maxwell, and Neville joins us from New Ireland, and he's going to be taking us through this presentation, and we've prepared an agenda here as well, which outlines some of the topics that we'll be going through today. So the main topic today, of course, auto-enrolment. What is it and who will be covered? We'll also be looking at payroll as well, how auto-enrolment will impact the payroll side of things, and looking at examples from payroll now and how payroll will function after auto-enrolment comes in. We'll be looking at contribution rates as well for the auto-enrolment scheme, and also some case studies, some useful examples. And we'll finally be looking at what this could mean for employers. What will you be doing in January 2026? And finally, we'll have a conclusion and a Q&A as well, and we'll encourage everyone to please type in your questions. You can log these as we go through the presentation, and we can review these at the end, any questions you may have. But indeed, if you don't have a chance to ask a question today, you can always submit this later on, and we'll be sure to get back to you as well. And with that, I'd like to hand over to Neville.
Thanks, Tiernan, and thanks everyone from Blue Chip and for everyone on the call, just for taking the time out to for us to go through this with you in a little bit of detail. So the key areas, I suppose, that as Tiernan has mentioned is that we want to go through how it'll operate. I'm sure you've all received information over the last number of months. Auto-enrolment has been on the agenda for actually about 20 years, believe it or not, and now it's finally going to come to fruition on the 1st of January in 2026. So auto-enrolment, our My Future Fund, is going to go live on the 1st of January, but there's some key aspects that you need to be aware of for your employees, and how you either protect your existing pension scheme and onboard members, or alternatively, if you do allow auto-enrolment to be the choice for your employees in terms of how their pension provision is provided. So the body that's going to run the My Future Fund is called NERSA. So it's the National Automatic Enrolment Retirement Savings Authority. So they're the body that's been set up by the Department of Social Protection, and they will run auto-enrolment. A couple of key things in terms of who is in and who is out. So members or employees will automatically be enrolled in the My Future Fund. If they do not have a pension scheme, or they're not a member of a pension scheme with contributions that are payable through salary deduction. So payroll is going to be the key driver here, how you run your payroll. If they earn more than 20,000 a year, and if they're aged between 23 and 60. So they will be automatically enrolled in the My Future Fund. But in addition to that, individuals can enroll into the My Future Fund if they do not have a pension, if they do earn less than 20,000 a year, and they're aged outside of that bracket. So there's the compulsory element of it, and then there's a voluntary element of it. A very important date is going to be December. So from the 1st of December, NERSA will communicate the assessments to determine who should be in auto-enrolment and who should not, through an AEPN, which is an auto-enrolment payroll notification file. So I'm going to go through that in a little bit of detail, if you just want to move on to the next slide, Tiernan. And I'm going to look at this from a payroll perspective, because this is very much a black and white situation. It's straightforward in terms of who will be included and who will not. So any of you on the call who are running payroll at the moment, you know that you have your employee data. You get the latest RPN file, you do your payroll calculations, you complete payroll, and then you submit contributions to the revenue, and you have it appearing on the pay slips, what people are paid, there are any tax deductions, PRSI deductions, etc. So it's a very simple process. It's all run through your payroll system, and it's like anything. It's how they collect tax, how they collect PRSI, etc., and how it gets remitted, and who's entitled to pay what, and who should be paying what. With auto-enrolment, the next slide is going to change that slightly. So what's going to happen in that situation is, in step 2, employers will have to deal with an AEPN, so the auto-enrolment payroll notification file. So this is where NERSA will actually identify those employees, or ask you to identify those employees who are not in a payroll at present. So effectively, where there's a zero contribution, either from an employer or an employee perspective, contributions into a pension scheme run through payroll. Once you do that, you then have to do your payroll calculations. Those who are in a pension scheme, those who are not, there'll be different calculations done. You complete your payroll, you submit your contributions then from a tax perspective, a PRSI perspective, which you will then also be sending across the contributions from an employer and employee perspective for auto-enrolment. Now, the rates on that I'll go through on the next slide, but this is a very straightforward process in terms of how they want to run this. And we'll talk about it a little bit later about how you can challenge this, how you can deal with it. But effectively, it's quite simple. An individual is either having a pension deduction made on their behalf through payroll, or they're not. If they're not, they're in auto-enrolment. If they are, then they're exempt for auto-enrolment on that payroll cycle. That starts on the 1st of December when employers are being told they will receive this notification file. And it's a look back over the last number of months. So you include people who are on that. So pretty simple, pretty straightforward, and also pretty blunt, I would say. So if we move on to the next slide, just to give you an idea of what are the contributions. So how much is this going to cost? So it's going to be calculated on an employee's gross earnings up to 80,000 a year. So this is slightly different to most pension schemes, which are set up with what we call a basic salary, and that's what the contributions are based on. So gross earnings up to 80,000 a year effectively means that every single month you might have your basic salary plus bonuses plus extra income that might be earned in that period. So it'll fluctuate every single month, the contribution rates you have to pay on behalf of employees and both yourself and the employee. There's no tax relief, okay, so it's going to be a government top-up. So quite different to existing pensions. Interestingly, for lower rate taxpayers, 20% taxpayers, it's the equivalent of kind of 25% tax relief. So it is a better top-up than what tax relief would actually give if you look at it on that single lens. But again, when we look at it in much broader detail, there's a lot of restrictions within auto-enrolment versus a pension scheme, a standard pension scheme. So for higher rate taxpayers, obviously auto-enrolment wouldn't make any sense whatsoever. And obviously, employers can offset those contributions against corporation tax. So if we go live on the 1st of January, for the first 3 years, the compulsory contribution will be 1.5 employee, 1.5 employer, and a government top-up. So a total of 3.5%, and that does not change. No additional voluntary contributions. Members can't decide, I'd like to put in more. You're fixed, you're locked into that system, and it's simple and it's straightforward. Then on years 4 to 6, it jumps to 3 and 3. Years 7 to 9, 4.5, 4.5, etc. And then after 10 years of auto-enrolment being in existence, it'll be 6 and 6 and a 2% government top-up, total of 14%. Key couple of points to remember here is, let's say we're in year 4. At that stage, the contributions will be 3 and 3 for a new member joining auto-enrolment or an existing individual. So they don't go back to that base rate of 1.5 and 1.5. So you can see here the cost of having a pension scheme, an auto-enrolment pension scheme for your business, what it'll be. So it's very predictable. You can see what's going to be there, but probably a little bit of a negative is obviously the tax relief element of it, and also the fact that it's going to be based on gross earnings. A little bit of history in the Australian environment where auto-enrolment is in place. When they first brought it out, it was a 1% employer-only contribution. There was a lot of uproar around that, and it's now up at about 12%, and employees can top up. So once this thing gets moving, it goes in one direction. It'll increase coverage, we know that. I'm not so sure if it's going to actually increase benefit adequacy, so how much you put into your fund. So just on to the next slide. I'm going to look at two case studies. So I think it was important that we looked at this from the view of existing clients that we have within New Ireland, because we've been obviously having this conversation for some time. So I'm looking at this from a company pension perspective where there's employees in a scheme. And this was a voluntary pension scheme with a 6-month waiting period. The employer was putting in 8% contribution, employee 5%, and they were onboarded or joined the pension scheme after 6 months service. So that's kind of a standard type pension scheme that would be set up. Obviously, pensions are seen as a benefit to employees. So a lot of employers are using these to attract employees, but also to retain them. We're in a very competitive jobs market. So as well as salary, pension, and all the other type of benefits that an employer can give are key. So the changes we made in consultation with the client was, and their advisor was sitting down to make changing the contribution scheme from being voluntary to compulsory for new hires. So that straight away avoided anyone potentially going into auto-enrolment. We did communications with the employees to make them aware. And anyone who hadn't already joined the scheme was automatically included from August 15. So this was one we did back during the summer, and their contracts were adjusted to reflect that. So there was amendments made to their employment contracts to say that a pension scheme was now compulsory and they're going to be onboarded. So if we look at just on the next slide, I suppose and let's look at what they wanted to do. The employer wanted to avoid running two schemes concurrently, right? Their concerns was gross salary versus basic salary. So that goes back to my point on the original slide. If you're trying to budget going forward a percentage of pension contribution for an employee based on basic or salary, that'll our gross, that'll always fluctuate every single year, every single month. So difficult to predict, and the employer want to avoid that. Retirement ages as well, they wanted to have that flexibility for people to be able to retire and draw down their benefits from age 50 if they left service. Auto-enrolment, on the other hand, you're locked into it until the state pension age, which at the moment is 66. So they wanted to create that flexibility. They also want to have different contribution rates in there and allow people to do ABCs and have a choice on their investments as well. So it was a very paternal type situation that we went to and got a solution for on that. Just on the next case study, then we had an employer in this particular scheme. It was 5% employee, 5% employer, and it was voluntary after 6 months service. So again, the considerations there, they felt compulsory membership and a change to retirement contracts would be actually difficult to do and wouldn't be seen as a positive. So HR and finance looked at this and kind of felt, no, we can't run like that. But they also wanted to reduce the number not in the pension scheme over a specific time frame. So they looked at this in terms of having a consultation, having a review, and they wanted to effectively engage with the employee to make them aware. So there was a communications engagement went on with all the employees in that organization. What did that look like? There was emails, presentations, one-to-ones to have a discussion. These were key employees. But again, there was a lack of engagement had occurred historically with that particular plan. They ran a communications period over 6 weeks. People were invited to join the pension scheme, and that coincided with the presentation. Members received an email saying you've been invited to join. All they had to do was click and join, and they were in. All the members were tracked, and then a final reminder was sent. So a review was done to see who had joined, who had not. No paper being completed, no paper applications in this instance. Through our platform, everything is done digitally, and the advisor drives that agenda. So just then the outcome of that, which we found was quite interesting, is that obviously the funding rate stayed the same. It was 5 and 5, and it was going to be based on basic salary. Existing staff obviously were offered the same pension scheme and the same terms as new hires. So there wasn't a differentiation there. People were treated equally. And again, the rationale behind that was to ensure there was no HR issues down the track of someone being offered one thing versus existing staff offered another, or new hires. So that was an important aspect, and we're seeing very much that trend in the market. You do not want to differentiate between your staff in terms of their roles. Obviously, you can have a scheme in place where directors, managers, floor staff, etc., have different contribution rates based on their contracts of employment, but you do need to make sure everyone is treated equally within those specific bands. The result was 92% of existing staff joined the pension scheme, and then we had a cohort that just didn't want to join. That was it. That was their decision. It was affordability, transparency, and then just inertia. That's the reality of a workforce within any organization. The employer obviously maintained their commitment to pension adequacy. They had a 92% uptake in the numbers of people actually joining. But the reality of it is, and I think this is something that we're quite clear on talking to clients and advisors like the guys in Blue Chip, is that not everyone will go into a pension scheme, and in certain cases people will just want to go down the auto-enrolment route. Just on to the next slide. And I suppose, what will employers be doing in 2025-26? So look, the question that keeps on coming out, will auto-enrolment go live on the 1st of January? Will it start? There's been a lot of false dawns on this. I have to say, we have to take the government, we have to take the Pensions Authority and Department of Social Protection for their word. They've been doing a huge amount of work. It's a mammoth task to get this thing live, but there's been a lot of work done in the background with payroll providers, with the fund managers that they've selected, and also with the whole processes behind the scenes. So we do feel it is going to go live. So employers need to actually think about what they're going to do. So what we see a lot of existing schemes do, a bit like what I've showed you earlier on, is they're reviewing their existing schemes, and in many cases they're making them compulsory for new hires. So they want to have their own bespoke pension plan. They want to run it themselves. They want to ensure that the pension scheme that they're offering is actually in line with what their industry is. So for example, if you're dealing with an engineering firm, a firm of architects, a firm of solicitors, pharma, you name it, there tends to be standards there of what kind of pension structure you need to be offering employees to retain them and attract them. So they're driving on with that. And then they're looking at the whole scheme eligibility rules for those existing employees. So go back to the two examples earlier on, they're looking to make their existing plans compulsory, and to try and opt in as many employees as possible, either through contract restructuring. So you make the scheme compulsory, and it's quite simple to do that from an operations perspective, or alternatively, you're inviting members in and trying to let them know about the benefit of what they're actually going to have and what the pension scheme is actually going to look like. And the fact that if they're in a company-sponsored pension scheme, the reality of it is they should have a better retirement income. They should have a better pot at the end of the day than what auto-enrolment would give. So benefit adequacy is a key communicator there. Key concerns of employers, and this is something that we've seen over the last 2 years. While auto-enrolment is now, we've had what we would call the IR2 legislation, which I know a lot of you would have had to go through, which is the movement of pension schemes from what we call single employer trust to master trust. And this has been a huge piece of work, probably ongoing for about 3 years. But I think now what we're seeing in the Irish market, there's been a whole-scale shift to master trust. There's probably about 500 single employer trusts left in the country. And they tend to be the very, very large employers who haven't made that decision yet to move. But when we start looking at the trends from other jurisdictions, the single employer trust market will reduce as we go through the next number of years. So what are their concerns? Quite different to what I think we used to talk about historically in the industry. Member engagement and communication is the #1 priority. Because if you're spending money as an employer on a pension scheme, if you're committing to this cost to attract people or to retain them, you want to make sure that they're engaged, they're getting the right communication, to effectively appreciate what's being provided to them. So that's been driven by advisors who are obviously going out and engaging with employees on a regular basis to give advice and to help them, but also through digital communications and awareness and nudge communication. So that's a big piece that's now being asked for. Costs are going to be very important as well. How much is going to cost me? And that links back to the engagement and communication. So, while we talk about management fees, the reality of it is if employers were staying in single employer trusts, there are huge administration costs and consultancy charges that can be there, and master trusts tend to reduce that and give a much more structured cost going forward. Service then, obviously it's number one. Auto-enrolment is going to be a digital system, like paying your taxes every single month as an employer, how you remit that. So service and how that gets delivered through a pension scheme is now being looked at with a very, very fine lens to ensure that you're running a pension scheme that can actually counter auto-enrolment to one degree, but also as an employer, you're looking to actually just run the pension scheme as smoothly and easily as possible, as opposed to traditionally dealing with paper, etc., and having to deal with lag times that really aren't acceptable in your industry and ours anymore. And then the last section is investments. Investments are key in terms of any pension, because where you invest your money, obviously how much you put in is key, but the growth rate is going to be important there as well. But they're the running order of what employers are looking at and what they want to see. And I suppose the last aspect then is that employers are looking at their current platforms, they're looking at their master trusts, they're looking at their PRSA schemes, their DC schemes, and seeing how can it actually cope with what's coming down the track. I think we talked about the IR2 legislation, but I think a key driver in terms of how pension schemes need to be looked at is if you're not capturing every single employee that you have in your that you're taking on every month, or is leaving every month, in a very seamless and straightforward fashion through your payroll, well, then those people could get caught up in auto-enrolment. And what we do know about auto-enrolment, once you're in, it's going to be a very laborious process to get people out, to get refunds of contributions, and that has to be dealt with by the employer and the employee through inertia. It's not going to be by your advisor. So the key is, I suppose, and I know we're going to go into a Q&A on this section, you need advice, obviously, to make the best choice for your business, but also your employees. I'm not saying auto-enrolment is something you should avoid. It might be perfect for your business. It might be the ideal solution. And we see employers going down that route. But if you don't want to go down that route, you need to prepare your existing pension scheme to ensure it's future-proofed. So that's enough of me talking now. Dave, Fergal, Tiernan, if there's any questions, I'm happy to go through them over the next few minutes.
Oh, thanks very much for that, Neville. Look, there's a few questions here, all right, for you. So I'll start you off with an easy one, right? So I suppose, is there any mechanism by which an employer can check in advance who's in and out? Is there a payroll file they can download, or is it just pension membership?
Very simply, if an employer is already making pension deductions and it's been done through payroll, irrespective of the product that they're in, the pension product that they're in, they will be exempt from the auto-enrolment pension scheme. But on the 1st of December, NERSA should be issuing an APN or a file over to all employers and their payroll providers that they need to complete to basically show that there's pension contributions being made on those individuals' behalf. So it's going to be, the key dates really are going to be December as a final checkpoint. But prior to that, if an employer can get employees into a pension scheme and have those deductions made through payroll, they will be exempt.
Perfect. Just the next question then, I suppose we all know it's the opt-out, but have we any sight of the mechanism by how people opt out of this? Like, what is the logistics involved? And then once they manage to do that, how do people get refunds? Is there any?
Yes. So if there's a number of opt-out dates that are there, people can opt out after 6 months. So in months 7 to 8 of auto-enrollment, once it begins, they can opt out. They get a refund of their contributions, but the employer contributions are kept. And then they will be re-enrolled. Then 2 years later, our confirmation will go to the employer to see if these individuals can be put back on the auto-enrollment file for collection. The other way to look at this is that if an individual is moved into a pension scheme, say after 3 or 4 months of auto-enrollment being in play, they can then be taken off the auto-enrollment system and they're in a normal pension scheme. And I think this is what we're seeing a lot of employers now think about and saying, right, I mightn't be able to get to this in this short window that we have over the next couple of months, but they are looking at, I need to look at my existing pension and I need to see, can I future-proof it in terms of every single month from January onwards, I'm going to be hiring new people. So I need to avoid this tic-tac back and forth. The individual, by the way, is the one that has to do the reclaim with their employer. So it's not something an advisor can do. So there is going to be a helpline through NERSA that people will be engaging with. I think they'll be busy.
Okay, so I have another question here that kind of half ties into the last point. So what happens if an employee makes an annual contribution rather than a regular monthly contribution? They'll be auto-enrolled, but I suppose how did they opt out, or what's the process there?
We are not 100% sure on that one. Right. Sorry for not giving a perfect answer. We've seen a situation where some employers make contributions at the end of the year, on their, for directors, etc., and they do once-off lump sums. We feel that won't really work. Because you're going to be on the file or off the file, if that makes sense.
Yeah.
And if you're not on the file in a particular month, then you need to be in the auto-enrollment file. We're still looking for clarity on that one, and I think the payroll providers are as well.
Okay, and then one other question here. So if there's a company scheme and somebody opts out but is auto-enrollment eligible, will they have to go into that? So basically, I suppose what this person's getting at is, and I know the answer myself, but would it be possible that you have to have a company scheme and administer auto-enrollment simultaneously? You would, I'd say. If there isn't compulsory membership.
Well, if you're in a pension scheme, you don't have to be in auto-enrollment. So
no, but I think what this person means is if there is a company scheme but someone isn't a member of it, this company, like the HR function, would have have a company scheme and auto-enrollment running side by side. Just, yeah,
100%. Yeah. And I think that will happen for many employers, because you're just going to have some people that get caught in it. I think running auto-enrollment will become pretty straightforward. Like I think the NERSA will do a good job, and actually the administration of it in the background, because it's simply going to be a function of how you pay your taxes and PRSI and any other payments. I think the key to this is that it's going to be like some of the issues I think employers are saying is, well, if I make contributions on behalf of someone into auto-enrollment and they leave after 4 or 5 months, I've lost those contributions. Whereas under a normal employer-sponsored pension scheme, those employer contributions are effectively owned by the employer for 2 years. So it's a cost that is guaranteed to be going out from a business, and they need to think about whether they're happy to have that kind of system or a bespoke pension scheme that suits what they want to do. That's where they sit down with you guys, and every scheme is going to be different within a master trust. That's what we see, but it's industry specific.
Okay, so another question here. So does there need to be both an employer and employee contribution to avoid AE, or will an employer contribution suffice?
Either, an employer or an employee is okay, as long as it's done through payroll deduction. That's the key piece here. So employer, employee. We do see employers kind of say, look, I just don't want to have anyone going into a pension scheme, into auto-enrollment. Can I put in a minimum amount? There are minimum amounts that any pension contract will actually take. So that has to be discussed with yourselves. And then the other piece to look at here, you're trying to actually, if you're trying to totally avoid auto-enrollment because you don't want to get caught up in it, well, what are you trying to provide for your employees? Is it a pension that is adequate, that is seen as beneficial, or is it avoiding auto-enrollment? So step back from the issue and look at actually what you want to achieve, I think is key for your employees.
Okay, perfect. So I see a hand up. Now, I don't actually know what to do with a hand up.
I'm not sure if we have microphones enabled for the webinar, so apologies for that. But if that attendee would like to either use the Q&A or indeed get in touch directly, we'd be sure to come around to their question and get an answer for them.
Yes, thanks, Kieran. Thanks, Neville and Fergal for the questions. I think I was interested just this week, Neville, in talking with you that there are developments this week in auto enrollment. I think is that you guys and most of the industry are waiting to hear on progress on that. And I mean, certainly the industry is convinced that January 1 is a real deadline and that all employers really need to observe it, take it seriously. And, the government position has been there that they could have done this earlier. They could have done this as early as this month or next month, but they were asked to stave off and leave it until January for a new tax year to allow salary and payroll providers ready themselves. And January 1 was better than an October or November deadline.
Yeah, like look, we've been hearing, and we've been, the communications we've been receiving out certainly has been about the January 1 start, and obviously, but it's December effectively is when that file has to be completed. But that means effectively members need to be in a pension scheme in November, okay, to have to be in that payroll run in November as opposed to December. So we're really getting close to the cutoff date for existing schemes. We are seeing, though, Dave, as we discussed, employers are looking at this and going, look, I need to actually future-proof. So I need to take a long-term view on how I deal with this on a monthly basis. So it's really that review of their existing scheme is going to be key. I think starting anything on the 1st of January is never a good idea. Be it I'm going to give up something, or I'm going to start training harder, or whatever. I think, in my view, from running pension schemes within New Ireland on our platform, My Pension 365, December is a short month from a payroll perspective. It's also an extremely busy month for a lot of employers, depending on your industry, but it's certainly a busy month from a finance perspective. And then January is the first week in January is when a lot of people are catching their breath. So I'm not sure if the timing is 100%, but that's not my call. I would always think, go back to the old days, an April 1 start is often a good idea, but who knows? I think be prepared as much as you can as an employer. And then after that, I think it's advice from you guys is going to be key. How to manage what I guarantee will be a bit of a mess. I think there is going to be people in auto-enrollment that possibly shouldn't be there or don't want to be there, and it's coming up with that solution after that. So it's
okay, great. And I think it's
just
stay calm, I suppose, is my advice.
Yeah.
We have a few more questions here. Yeah, no, it's just, so I suppose one question there, Neville, is this person has asked, so do employers, are they correct in thinking that employers do not get their contributions back if an employee opts out of the scheme after 6 months?
Yeah.
Yeah, no, I thought that. So another one is, if an employer has an objective to set up a private pension, can they defer AE for a period of time? The answer to that is no. They have to look at that for July next year, I'd imagine myself.
Well, no, I think what we're seeing employers do is they're saying, look, once this deadline starts, you're in. You have to start making that submission. So there's no, if you don't have a pension scheme, but if you do set up a pension scheme down the tracks into next year, then once you start having members in that pension scheme, you obviously through NERSA, there will not be the need to make contributions into the auto-enrollment pension scheme, but obviously each individual has to go in and complete a notification to say they're now in a pension scheme, and the employer has to remit contributions that way. So it's going to be cumbersome, to be honest, but it could. But those contributions that have been made into the NERSA scheme or the My Future Fund scheme they're not refundable to the employer. They're in those individuals' accounts. They're owned by the individual. They can access them hopefully at age 66 or whatever the drawdown date is finalised at.
Perfect. Now here's the last question. It's actually quite a good one. So will the employer have to assess eligibility every month? Like obviously the 20,000 euro salary, is it a monthly assessment, or is it just all automatically looking at the payroll systems speaking to each other?
It's the payroll systems basically identifying who should be in, who should be not. And if there's a contribution being made in, there will be parameters set, there will be data points set, so that the age profile, the salary. Interestingly, what if you have a situation where you have someone working 2 jobs, they're 15,000 maybe with one employer and 50,000 with another, or sorry, 10,000 with another. How will they, in isolation, they shouldn't be auto-enrolled, but our understanding of it is because it's all going to be done through the payroll submission request files and AEPN files, or auto-enrollment request files. Everything is going to be driven out of your PPS number. So that's the unique identifier that everyone will be identified through, and contributions determined by. It's going to be very complex in the background, but in fairness to NERSA, they're doing this exactly the same way they collect tax. So I think I mentioned it, if you're on the wrong tax band, it's up to you to tell the tax person that you should be on a different one, and to prove it, NERSA will operate and the Future Fund will operate the same way.
Perfect. Yeah. Well, that seems to be all the questions there. Just I've actually only So unless anyone else has anything else.
Well, we did pretty well on time, everyone. Thank you all for sticking with us this long. And Neville, thank you for that presentation. It was one of the more concise ones, but we did actually cover a lot, and we hope that served as a sort of a refresher on information for many of you, but also hopefully helped you in terms of making plans for the future and auto-enrollment coming into effect. As we said at the beginning, if anyone did not get a chance to ask their question, or if you have any questions after the presentation, we would encourage you to get in touch with us directly, and we'll also be sharing this webinar by email with all attendees as well. So thank you all again. Thank you, Neville.
Thanks, everybody. Take care.
Thank you. Thanks, Neville.
Bye-bye.